Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dongfang Electric Corporation Limited Annual Report. Dongfang Electric Corporation Limited offers a diverse range of businesses and services across various sectors. At its core, the company designs, develops, manufactures, and sells power generation equipment for different types of energy sources, including wind, solar, hydropower, nuclear, gas, and thermal power. The company operates in 5 distinct segments: renewable energy equipment, high-efficient clean energy equipment, engineering and supply chain, modern manufacturing services business, and emerging growth industries. Within these segments, Dongfang Electric provides a wide array of products and services, including power generation equipment for various types of energy sources, engineering, contracting, and services to global energy operators, trade and logistics services, chemical containers, energy saving and environmental protection, power electronics and control, and hydrogen energy equipment, science and technology promotion, and application heat production research, and experimental development services, power generators, generating sets, and general equipment. These diverse offerings enable Dongfang Electric to cater to the needs of various industries and customers worldwide. Dongfang Electric Corporation Limited market capitalization of 135 billion is significantly larger than the average industry peer of roughly 26 billion. This shows that Dongfang Electric Corporation Limited holds a significant advantage in their industry. Dongfang Electric Corporation Limited trades at a higher price-to-earnings ratio of 30 times and a higher price-to-book ratio of 2.6 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 70% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company can be identified through various factors. On one hand, revenue growth is driven by several key areas. Energy equipment manufacturing has seen significant increases in gross profit margin and sales, with wind power units experiencing a 41% increase in sales. Emerging industries products have also contributed to revenue growth, with a 0.95% increase in gross profit margin. Additionally, the company's energy equipment manufacturing segment has shown impressive growth across various types of power generation, including coal-fired, hydroelectric, nuclear, and wind power. On the other hand, revenue decline is attributed to several factors. Manufacturing services have seen a significant decline of 18.2%, while natural gas-fired power has experienced a decline of 21.1%. Bidding service fees and advances have also contributed to revenue decline, with decreases of $15 million and $237 million respectively. Furthermore, operating lease revenue has decreased by $5.8 million. Interestingly, some business units have shown stable revenue growth. Dongfang Electric Group Digital Technology Co., Limited, and Honghua International Co., Limited, have maintained steady revenue streams. Overall, the company's revenue growth or decline is influenced by a complex interplay of various factors, including sales, gross profit margin, raw material costs, labor costs, government grants, interest income, and operating lease revenue. Net income and profit margins. A changing landscape. The extracted summaries reveal a complex picture of how net income and profit margins have changed over time. On one hand, net income increased by 397,851,500 $527.86 from 2024 to 2025, marking a significant growth of 31.11%. However, this increase is contradicted by another figure that shows a decrease of $6,504,050.13 in 2025 compared to 2024. Despite the inconsistencies, it is clear that net income has undergone significant fluctuations between 2023 and 2025. The largest decline was seen from 2023 to 2024, with a drop of $9,716,626,728.62. On the other hand, there was a substantial increase of $2,321,793,989.65 from 2024 to 2025. Profit margins have also experienced changes over time. The operating margin increased significantly from 12.7% in 2023 to 19.3% in 2024, while the net profit margin rose from 11.2% to 18.6%. However, the gross margin decreased slightly from 73.4% to 72.5% between 2023 and 2024. The reasons behind these changes are not explicitly stated in the summaries, leaving room for further analysis and interpretation. Nevertheless, it is evident that net income and profit margins have undergone significant fluctuations over time, with some periods of growth and others of decline. The company's ability to generate positive operating cash flow is a mixed bag. On one hand, there are several instances where the company has reported positive operating cash flow, including on pages 44, 159, 209, 211, 214, 220, 286, and 302. These reports indicate that in these specific periods, the company was able to generate sufficient cash from its operations to cover its expenses. However, there are also instances where the company has reported negative operating cash flow. For example, on pages 8, 9, and 160, it is stated that the company generated negative operating cash flow in certain years or periods. Additionally, page 273 reports a net operating cash flow of negative. These findings suggest that the company's ability to generate positive operating cash flow is not consistent across all periods. Overall, while there are instances where the company has reported positive operating cash flow, the presence of negative operating cash flow in other periods raises concerns about the company's financial stability and its ability to sustain long-term growth. The company's debt level has undergone significant changes over the past year. Notably, short-term borrowings have increased by 88% from $75,080,000 to $141,302,980.52, while long-term borrowings have also seen a substantial rise, increasing from CNY $886,948,500 to CNY $1,720,000,000. Furthermore, total liabilities have increased by 16% from CNY $98,867,036,719.24 to CNY $114,505,939,883.61. In terms of interest expenses, the picture is more complex. While there are instances where interest expenses have decreased, such as in 2025 compared to 2024, with a decrease from CNY $82,971,078.48 to CNY $61,582,139.16. Other periods show an increase in total interest expenses, including the current period, which saw a rise from $1,419,111.51 to $2,444,119.11. Overall, the company's debt level has increased significantly across various categories, while interest expenses have shown mixed results, with both decreases and increases observed over different periods. The financial performance of the company can be analyzed based on various segments or regions that performed well or poorly. In terms of poor performance, the net increase in customer deposits and interbank deposits saw a significant decline of 60.51%. Additionally, central bank and interbank payments also decreased by 57.98%, indicating a slowdown in these areas. Furthermore, cash received from return on investments dropped by 28.66%, while net cash flows from investing activities plummeted by 381.51% due to increased expenses for purchasing fixed assets. On the other hand, some segments showed good performance. Other cash received from operating activities saw an increase of 32.29%, indicating a positive trend in this area. Cash paid for purchase of goods and receipt of services also rose by 40.03%. Moreover, cash received from borrowings obtained surged by 121.74%, showing a significant improvement in this segment. However, it's worth noting that despite the poor performance in some areas, the company's overall cash flows from operating activities increased by 10.59% in 2025. This indicates that while there were challenges in certain segments, the company was still able to generate positive cash flows overall. Management's vision for the company revolves around driving growth through strategic initiatives. To achieve this, they aim to deepen reforms and improve efficiency, innovation, and quality management. Page 46. This includes promoting emerging industries and strengthening headquarters functions. A key aspect of their strategy is advancing regional operations and cross-border industrial chain layout to enhance international market competitiveness. Page 47. They also plan to implement targeted development strategies to drive growth. Furthermore, they will organize the implementation of annual business plans and investments, propose development programs, and formulate internal management systems. Page 77. To ensure sound development, management intends to strengthen control mechanisms. Page 83, while focusing on improving operational efficiency and reducing costs to drive long-term profitability. Page 157. Additionally, they aim to maintain a strong cash flow from operating activities, with a net increase of CNY 2.01 billion in 2025, compared to CNY 10.06 billion in 2024. Page 159. The company's financial performance is expected to improve, with an increase in operating income by $293 million and investment income by $274 million compared to the previous period. Page 328. Overall, management's strategy emphasizes driving growth through strategic initiatives, improving operational efficiency, and maintaining a strong cash flow. The company has a history of paying dividends to its shareholders. According to the provided references on page 2, it is stated that a cash dividend of Rm billion, 832,930,972.78 will be distributed for every 10 shares, amounting to RMB 5.3 per share. This information is further confirmed on page 314, where the total cash dividend is mentioned as RMB 1,832,930,972.78. The confirmation of dividends being paid can also be seen on page 319, which explicitly states, dividends received. Yes, this indicates that the company has indeed distributed dividends to its shareholders in the past. The company's financial reports reveal a pressing concern regarding inventory buildup and potential supply chain disruptions. A significant increase in raw materials inventory by 457% from 2024 to 2025, page 216, suggests an overstocking issue, which can lead to wasted resources and decreased efficiency. Furthermore, the hydro generating unit experienced a substantial plus 282.4% increase in inventory from the previous year, page 25, indicating a potential mismatch between production and demand. The financial implications of this buildup are also evident, with a loss from inventory depreciation totaling $580,368,020.57 for the current period, page 264. While there is no explicit mention of supply chain disruptions, the concerns about inventory buildup may indicate underlying issues that could lead to such problems in the future. That concludes the financial summary for Dongfang Electric Corporation Limited. Feel free to comment below, and I will be happy to answer them when possible.